What's up, you guys? Happy 4th of July weekend. Today I want to talk with all of you about why you, yes you, should consider investing in real estate, whether it's today, 5 years from now, whatever. I want to explain why people invest in real estate and why the majority of millionaires and even billionaires, but primarily I want to focus on the term financial freedom. Primarily those who have achieved financial freedom have invested either solely or partly in real estate investment. So before we get started, please hit the like button below and definitely subscribe if you guys have seen some videos before. I appreciate all those who have subscribed to date. And we're going to go ahead and hop in. But first, a full disclaimer. I personally am not a licensed investment advisor of any kind, nor do I really consider myself a professional investor. This is all based on a ton of research that I have done, a lot of reading over the years, networking, and most importantly, personal experience buying a few rental properties in our own personal residence as well. And lastly, before we get too far in the video, these are all even numbers in some of the examples, and you do not need a crazy amount of money to get started in real estate. And oftentimes there are creative ways such as rental arbitrage or co-investing with a colleague, or a ton of other ways that we've talked about in previous videos and will in future videos. You really don't need any money at all to get started in real estate. There are tons of ways to get your foot in the door. All right, so first I wanted to outline some of the goals and really the sole purpose in investing in real estate. It's not to amass, tons of money and, be in the top 1% and just be ultra rich. Although a lot of times that may come with long-term investment in things like real estate. The number one goal we have is to achieve financial freedom. And what does financial freedom mean? Financial freedom is quite literally having the freedom of time to do what you want, when you want, with whom you want, and how you want, right? So not having a burden necessarily on a particular 9-to-5 job that you may or may not like, and you can ultimately be in charge of how you and your family spend your time today and every day in the future. And again, while our sole goal isn't to get rich by any standard, because financial freedom is different for every person on every level, right? Financial freedom quite literally is achieving the amount of money on a monthly basis in, passive or, somewhat passive income or cash flow from real estate or other investments that totally offset our living expenses and other variable expenses that you or your family may need to basically survive in life and fit your lifestyle. It is about building long-term and even generational wealth. And again, this is for family, this is for friends, and allowing you to spend time with loved ones. You could invest in real estate to basically pay for your children's, college education. You could buy real estate in order to pay for the mortgage on the house that you're living in, and so forth. Because ultimately, a lot of us want to invest in real estate to free up time for ourselves so we can ultimately spend time with loved ones, right? It also is going to open up extra money or cash flow to where we can spend, invest in, or donate that money to things that really matter to us, whether it's a charitable organization, something domestically or abroad where you're serving a good cause and helping other people. And much, much more. But really the possibilities are endless, and the ultimate point I want to get across to you guys is investing in real estate is ultimately about freeing up time and resources in your life to do exactly what you want without having the ultimate burden of going to work every day for the sole purpose of providing for your family. And again, whether you like that job or not, ultimately, you're spending the majority of your life doing this until age 60, 65, 70 years old when society tells us we're supposed to be able to retire. All right, so you guys will hear me all the time talk about really the top 4 benefits of investing in rental properties in specific. Number 1 is cash flow. Again, this is money that you are bringing in from a lease agreement, or if it's a vacation rental, what renters are paying you each week or each month that exceeds the amount you pay in mortgage and other variable expenses. So that is going to be your take home, your cash flow. And that's what we're ultimately after, because we need to achieve some set or some amount of cash flow, again, to offset our living expenses to achieve financial freedom. Next is equity or loan pay down. So essentially, when you take money out from a bank or a private lender, hard money loan, whatever it is, you're leveraging other people's money to buy this asset, this house, this apartment, this condo, whatever it is in real estate. So you can put as little as 5 to 10, 20, 25% down, whatever your investment is specifically. You're leveraging the rest of that money from the bank, and then with your renters paying you each month, they're ultimately paying the mortgage costs, right? So they're paying the loan down for you. So whatever the principal balance is each month, that is basically money being deposited in your bank account or right directly into your pocket. And with appreciation, again, this is just icing on the cake, right? Sometimes it's just keeping up with inflation. Sometimes in growing areas, whether if you're in a big city or a growing vacation destination, appreciation climbs quite a bit. It could be anywhere from 2 to 5, sometimes higher percent. And occasionally in some economic downturns, it could go down. But overall, over the course of longer term outlook, it's typically around 2 to 4%, sometimes 5%, which most real estate investors account for in their calculations. So again, if you buy a $100,000 house and it appreciates 3% that year, you are now $3,000 richer based on the value of that house the next year. And the last benefit is great longer term, especially once you transition to doing real estate full time, if that's what you want to do. You get tax sheltering and tax benefits. And there's nothing wrong with this, right? There's tax law written to help encourage people to invest in real estate, invest in property that ultimately will pad your investment longer term. And we can get into this, there's a whole bunch of different tax rabbit holes that we can get into. But, one that you can think about, right, is your expenses each month to upkeep the property and the value of the house technically depreciating as the physical infrastructure of the house over time. You can account for that when you file your taxes each year. So it actually offsets the money that you're making in cash flow, and oftentimes you pay little to even no taxes based on your real estate investment. So it's a great way to shelter your hard-earned money and let it grow, tax-free or with little taxes long term. All right, on my channel, I typically talk about short-term rentals, but we're going to look at both short-term and long-term rentals and some of the benefits of both. So with short-term rentals, you hear STR, and long-term rentals, LTR for short. So with most STRs, you're going to think Airbnb, VRBO, HomeAway, Booking.com, all these places where basically you are renting it out essentially like a hotel. You're looking for a place to rent for the weekend or maybe a week, sometimes a month, but you're not looking to sign a lease agreement for a 6, 12, or 24-month period where you're paying monthly rent each month. So STRs, you're renting out on a short-term basis, commonly known or referred to as a vacation rental. Typically, in high tourism areas, you're going to see more vacation rentals. Think Nashville, Austin, Texas, New York, San Francisco, the mountains, lake houses, beaches, things like that. Now, typically with STRs, you're going to earn a much higher cash-on-cash return, which we'll go over in a few slides, instead of long-term rentals. And we will talk about the reason that is as well. Short-term rentals, though, can be seasonal based on location. If it is a vacation rental, you can actually use it as a personal vacation house and make money year-round while you're not there. So if you guys in your family love going to the lake, why not buy a lake house and rent it out year-round and just block off the days that you want to use the house? I mean, it's just a genius way to enjoy an investment instead of you actually going to purchase a house for only you to use it, but then you're stuck with 2 mortgages. Why not have somebody else or a bunch of other people paying off the mortgage and paying you each month to pay for your vacation every year? Honestly, it's a tremendous strategy for those looking to get into real estate that may have the money and they're looking at buying a vacation home for their family. Now, long-term rentals. Typically, again, it's a lease agreement that you, the owner, would have with a tenant renting out for a fixed number of months based on a monthly rent or rate. I think it's definitely more hands-off than an STR if you are managing your Airbnb yourself, which most people do. I would recommend doing for at least the first few. And as you scale, you may have to hire a management company, and then they're equally both hands-off, right? But if you're doing a long-term rental, typically you're accounting for the management fees in your investment. And it's typically more hands-off because you don't want to be a landlord ultimately and deal with all the maintenance issues. You just want to be solely the investor and pay somebody else to manage that property for you. And again, typically lower cash-on-cash return, and you definitely need to hunt to find a great deal, especially right now with the housing market is doing pretty well. So the better deals are few and far between, and there's a lot of competition out there versus short-term rentals. If you find a a good house in a good location and you make it look super nice, take great photos, you're going to be able to be competitive right away. All right, so just to elaborate on why personally I like short-term rentals, at least right now. So why short-term rentals? Typically, and I say typically is what the star there is for, is typically you have much greater cash flow. And most long-term rentals you might shoot for $200 to $500 a door or a room in your investments, where short-term rentals you can make thousands of dollars a month in cash flow. And again, this is typical, but only if you do it right, you have a good spot and a good location, take good photos, and advertise the property well. So for me, it accelerates the pace at which you can scale to your second, third, fourth, fifth, etc. properties. And typically short-term rentals have a higher resale value. And again, this is based on my opinion and my own research. And I'll give you an example. There was a short-term rental that we just bought in downtown Nashville, and it wasn't even on the market. It was an off-market property that was listed locally just out to investors and real estate agents. And it had over 8 offers within 24 hours, and we closed on the house, and we were under contract within 48 hours. So we closed on it about a month after that. But again, highly competitive, and a lot of those times it drives up the prices. So if you own that short-term rental and it has rental history, based on the return on investment, as soon as you have that property up for sale, you're going to probably have a flock of investors looking to chomping at the bit to get an offer in on your property. Again, for at least your first few properties, it is very, very easy to self-manage once it's set up. You can hire a cleaning service, so that's hands off. You really just have to check in once in a while to make sure there's no small maintenance updates that you need to do, or maybe restocking, again, toilet paper or soap, shampoo, whatever you provide for your guests. Again, typically a higher cash on cash return. Again, this is because you're allowed to charge a higher nightly rate. Think about hotels. It's much cheaper to rent a place for 12 months on a lease than it is to stay in a hotel for 12 months based on their nightly rate. So same thing with, if you operate an Airbnb. If someone's coming to visit you in a city or at the lake, then you're able to charge a nightly rate that is much higher than it would be if you were to do a long-term lease. In my opinion, STR heavy markets, again, high tourism areas are often bad markets to do long-term rentals. Again, unless you really hunt for a deal, and it's also a place where a lot of people are moving today. I'll give you an example. So Nashville is a very, very fast growing city. There are tons of people moving here every single day. It's also a super big and high tourism market, primarily with the live music scene downtown on Lower Broadway. But again, STRs are going to produce way better. And again, a lot of the long-term rental units that I've tried to look up and think about investing in, the deals are few and far between. You have to really hunt for a winner, and a lot of times you have to buy a place that's super beat up and spend time rehabbing it, and to get a much better value on your deal long term. So again, a lot more work needs to be put in on that up front, in my opinion. And I think in high tourism areas, again, STR markets are going to be your best bet. The other cool thing about STRs is if your STR is struggling, example, due to COVID-19, it's been crazy. We had 3 months where it was really slow. It's picked back up, and now there's some people trying to cancel again because, again, there's a worry about the next wave of, COVID cases coming out. But whatever. So a lot of people, what they're doing is they're actually taking their STRs and throwing it out there as a long-term option for folks. So again, you have that flexibility. If you have a nice furnished place where you could list it as a long-term rental to at least pad your costs or earn a little bit money for the next 6 to 12 months until the short-term rental market bounces back. Again, you can't always do that with the long-term rental. If you're barely making any cash flow in a long-term rental and you're in a booming market where you could be making maybe $1,000 or $2,000 a month as a short-term rental, you can't necessarily kick that, the tenant out, right? So you're kind of locked into that lease for the remainder of the period. So it doesn't exactly give you the flexibility the other way. All right, so the key metrics in real estate investment or rental property specifically: cash flow, cash on cash return, total return on investment. And again, for long-term rentals or commercial properties, you'll hear a lot of people focus on capitalization or cap rate. We'll talk about that in a different video. But again, for the few of the basic real estate investment metrics, we're going to be looking at cash flow, cash on cash return, and total return on investment. So cash flow, we kind of already hit on this. It's quite literally the total dollars earned or your gross revenue from bookings or from your monthly lease agreement, right? Your rent in a given month minus the total expenses. So I'll give you an example for STRs. So expenses could include, but again, aren't necessarily limited to, mortgage, insurance, property taxes, utility costs, HOA fees, cleaning service, but cleaning service really is padded because it'll be paid by your guests anyway on Airbnb. You can charge a cleaning fee. Repairs and refurnishing costs, restocking such as toilet paper, welcome gifts, detergent, coffee, whatever else you provide for your guests, and miscellaneous costs. Again, if you're in an area where you need to pay an extra trash fee outside of an HOA agreement, or pest, or a lawn service, whatever it is. So again, cash flow is your total revenue or your gross revenue minus your total expenses. Now let's look at the cash on cash return, because again, think about investing in the stock market. You invest $10,000 into the stock market, and at the end of that year, you have $11,000. So your cash on cash, or your return on that investment, would be 10% because you made $1,000 on your $10,000 investment. So it's very similar here. We're looking at how much cash flow we earn throughout the year divided by the money invested up front. So I always look at it just on a 1-year term or annual term, especially for the first year of your investment. And you can look at other investment metrics longer term as well. But again, we're going to focus just on this annual cash on cash return metric here. So for example, in 2020, let's say we have a net cash flow of $8,000 for the year. And again, maybe the total property value was $250,000. We put 20% down, so $50,000 out of pocket. And how do we get our cash on cash return? You take the $8,000 in cash flow divided by the total money invested up front of $50,000, and that gives us 16%. And that's a pretty solid number. And on most cases in my STR investments, I'm looking for 20 to 30% plus. But again, most long-term rentals or the stock market, you're looking for 10 to 12% plus. So this is why STRs are going to provide a much higher cash on cash return typically. Now, this is where it gets really exciting. So if we're going to look at the total return on investment, we're not just looking at the net cash flow. We're also looking at loan or equity pay down, and then appreciation. Appreciation, again, icing on the cake. But again, we account for all of this in the total return on our investment, and then you divide it again by the investment up front. So we'll continue off that same example. Let's say the example again, $250,000 property. Your total investment up front is $50,000. Your 2020 net cash flow was $8,000. And we'll look at appreciation at 3%, which is probably an average around par with what the appreciation would be in 2020, and we get $7,500 from appreciation alone. And then equity or loan pay down. So if you look at your amortization schedule, you take a loan out from the bank each month. Let's say it's a 30-year term. You're paying a little bit each month in principal balance, which is paying the principal down on the house, and then you're paying a sum of interest owed to the bank. And over time, the interest goes down each month and the principal goes up each month until the house is paid off at the end of the 30-year term. So for the first 12 months, it's going to be the lowest amount over that 30-year term as far as principal or equity that you're going to be paying down in the house. Or I should say that your renters are paying down in the house for you. But in this particular example, I looked at it and just did a standard interest rate for an investment property, and it was about $292 a month for the first 12 months, or $3,504 total for the first year based on that amortization schedule. So this is where it's really cool, guys. So if we look at what our total return on investment for 2020 would be, we have $8,000 in cash flow, $7,500 from appreciation, and $3,504 from equity or loan pay down. And again, we add that up and divide it by the $50,000 invested up front, and our total return on investment is 38%. And again, this is likely going to grow over time with equity, loan pay down, and appreciation continuing to grow value in the house. And our cash flows are likely going to grow as well because you're going to be able to charge more. Again, if it's a long-term rental, and monthly rents are going to increase, and typically you're going to be able to charge more on a nightly rate over time with your short-term rental. So here's a few things to consider as you are looking into investments. All right, so one is going to be the type of loan. You can get it from, again, a hard money loan, or maybe a cash investor who just wants to be hands off and you can manage the property. That's how you get into real estate with little to no money. You can partner up with somebody. But typically there's going to be two types of loans you can do. Most of the time they're going to be an investment property loan, or say you have a primary residence somewhere, you can actually get a secondary home loan. And what's cool about this is this is basically for people who are looking to buy a vacation house. Say you live in Raleigh, North Carolina, but you want to buy a house in Wilmington at the beach. You can get a secondary home loan, which oftentimes you're only going to have to put down maybe as little as 10%, which is great because most investment properties, they're going to require you to put down around 20 to 25%, some cases less. I've put down as little as 15% on an investment property loan, but secondary home loan is going to give you a lower interest rate and a lower money down. And what's cool about that is you can obviously use that house whenever you want as a vacation home, but you can rent it out year round as well. So you're going to get a much higher return on your money because one, you have to put less money down and you can leverage more of the bank's money. And two, you're going to have a much lower interest rate than it would be for an investment property loan. So another thing to consider again is the interest rate. How much will a rate cost you, or how much will a better rate cost you? A lot of times in your closing costs, the lender will offer you a rate table and you could buy down a lower rate. So again, you just have to look at your investment and see what is worth spending out of pocket versus the long-term cost of the loan and see what is going to get you the best return on your money. How much will you put down? Again, if you put down 10% versus 20%, how much will that cost you in PMI, which is private mortgage insurance? The banks will typically charge PMI if it's less than a 20% down payment. Now, so a lot of the times it may be worth putting a lot less down because again, that's a lot less money out of pocket. Your return on your investment will be higher, but how much is that PMI going to be? Is it going to be $50 a month, $200 a month? And again, that's just money being pissed away basically. But again, if your investment makes more sense to put less money down and pay PMI, do it. Another thing to consider, again, this is going to be more STR specific, is your estimated nightly rate and your occupancy rate. I would say take, obviously your best guess or best estimate based on the research you've done, but definitely make a low and also a high estimate so you can make sure you can afford the investment and it still makes sense even if it was on the lower spectrum. And same thing with a long-term rental. You have to figure out how much you could charge in monthly rent. For STRs, if you're going to be furnishing it on your own, which unless it comes furnished, you have to account for furnishing costs up front. So it's not necessarily just the down payment and the closing costs, but how much will it cost you to furnish that house? How many rooms does it have? How many common living spaces does it have? Outdoor patio space? What else do you have to spend out of pocket? Now, a lot of things that people may not consider up front is having an emergency or rainy day funds. This is similar to having a rainy day fund in your own personal budget, but not only for yourself, but for your rental units as well. Again, I think coronavirus, woke up a lot of investors and said, holy crap, I need to have maybe 2 to 3 months of expenses for that property, for the mortgage and whatever, utility bills that you have to pay in order to stay afloat and kind of weather the storm in any crazy circumstance like we've been in the past several months. What are your insurance costs? They are different than normal homeowners insurance. It's going to be a little bit more expensive as an STR because you're getting STR specific insurance that protects you against the liability. Again, if somebody maybe gets hurt or breaks something in your house, again, you're protected, and oftentimes they may help pay the damages. Or if you are unable to rent your place, they'll often pay you an income loss for a few months, which is great as well. Professional photos, something you definitely must do. Professional photos, you guys have probably already all been on Airbnb, and if you're scrolling through properties and if one has some photos, looks like it's taken off, a razor phone or something that's all blurry and bummy, you just buzz right by that property. You're like, I don't want to stay there. In most cases, right? If you have a place that's furnished well and has great, well-lit photos, that place is going to be inviting and you're probably going to be willing to spend more money. It's going to get better reviews because the place looks nicer, more interest in it, more views. It's going to boost your rank on Airbnb search and everything. Professional photos, I cannot tell you guys this enough on how important it is. The last thing to consider, once the property is paid off, again, typically 30 years if it's a 30-year term, or if you pay the house off sooner, once it's paid off, your cash flow jumps considerably, right? You don't have to pay a mortgage cost anymore. So if you're paying $1,500 in mortgage, now all of a sudden your cash flow is $1,500 higher every month in perpetuity. As you scale to multiple properties, think about a retirement nest egg, and we're about to go over a specific example here, but once those houses are paid off, you have full equity in the house plus appreciation. That's basically money in the bank, and then you have ongoing cash flow or passive income each month with each of those properties. All right, so I want to talk about accelerated wealth building with rental properties. Again, these are just nice even numbers, all right? So I'm just going to use this as an example. Your investment could be much less in dollar amount or it could be much higher in dollar amount. It's really up to you. Each investment is different. So we're going to be looking again at the similar example from before and just assume each house the annual cash flow is $8,000. And once we scale to 3 houses, we're going to save up the cash flow for the first few years, and we're going to be able to invest in 2 more properties, right? And you'll hear, on Bigger Pockets or other places, they'll often refer to this as the stack, and you're able to scale as you get more properties because you have more cash flow coming in. So once you're at 3 properties, you'll have $24,000 a year in cash flow. 7 properties, $56,000 a year in cash flow. 13 properties, you're over 6 figures in cash flow alone for the year. So again, at this point, whatever your financial freedom number is, If you're able to scale to 13 rental properties, you're now earning six-figure residual income. And this is where it gets exciting, guys, because once you have 100 grand plus a year in cash flow, think about how many investments you can make each year solely based on the residual income you're earning from there. Once you scale to 20 properties, again, based on this example, you'll have $176,000 in annual residual income or cash flow, which is pretty substantial. And now we're going to look at the appreciation for each property and then the equity and loan pay down each year. So these are all going to be even numbers just to help it make sense for you guys watching. But let's assume all houses are paid off. Assuming each house was worth 250 grand when purchased, the equity in each house that is now paid down, right? The loan's paid down completely. So you now have 250 grand worth in equity in that house. But that's not it, right? Because we also have to assume each house is going to appreciate, let's say an average of 3% per year. At the end of those 30 years, this is what's cool about compound interest, is each house is going to go from 250 grand in property value to around $607,000 per house. So again, earn only from appreciation is going to be $357,000 for you doing nothing. I mean, literally you're just sitting on your investment, renting it out to people, earning cash flow, they're paying down the house for you. And then when you wake up 30, 40 years from now, whenever the loan's paid off, the house is going to be worth $600,000 plus. Now, once you have 10 properties, think about that. 607 grand times 10 properties, you're going to have over $6 million worth in property value or in equity in real estate. 20 properties, you're going to have over $12 million. And again, you may not hold on to each of these properties for the whole 30 years. You may consolidate and sell for better investments, but hypothetically, just looking at how real estate and how people build significant wealth long term, you can see not only are you going to have, again, if you have 20 properties, you'll have $12 million worth in equity or net worth, but you'll also have $176,000 in annual cash flow. Now, in my opinion, that sure beats a 401k or any mutual fund, and often the stock market in most cases. What could, $176,000 in annual cash flow do for you and your family at retirement or far into retirement when you also have 12 million in equity in houses? You could sell several of those houses, maybe live in your dream home, maybe travel the world throughout the end of your years. But again, this is how people achieve financial freedom. And again, this is how people, quote unquote, retire early. Really, it's all about doing what you want, how you want, with whom you want, when you want, all that good stuff, guys. That's what financial freedom will do for you. And I believe the fastest way to achieving financial freedom is through real estate and investing in rental properties. And everybody can do it. Don't be discouraged because I don't have $50,000 to invest today. Again, watch some of my other videos, watch other people's videos. There's other ways to invest in real estate and earn significant cash flow with little to no money. The last video I did was on rental arbitrage, and that is a genius way to make up thousands of dollars a month potentially with putting little to no money up front out of pocket. So I encourage you guys to check out that video. Again, subscribe below, guys. If you like this one, please hit the like button. Again, it helps the YouTube algorithm. It helps get my content out there. I really appreciate y'all watching today, and we'll see y'all next time.